Poison solution. Various strategies are required to perform well in a competitive examination. The strategy adopted here is likely to yield much better results than any other method. This material is being provided in audio format to help such candidates who spend long hours traveling or for whom listening is preferable to reading. Discussion-oriented solution for IBPS paper dated 17th June 2012. Conceived, collated and prepared by Ravindranath. Audio recording date 17th December 2014. Sources of information largely Wikipedia and various websites. Target group candidates preparing for IBPS officers examinations. This helps only for general awareness paper. It is also useful to persons of all age groups to improve their general awareness. Questions not requiring expansion have not been considered. Repetitions, if any, are intended. Question number 101. The money deposit at a bank for 102. A worldwide financial messaging network which exchanges messages between banks and financial institutions is known as dash A. CHAPS, B. SWIFT, C. NEFT, D. SFMS, E. CHIPS, CHIPS. Now, let us consider the answers. CHAPS, that is CHAPS. It is an acronym for the Clearing House Automated Payment System. It is a British company established in London in 1984, which offers same-day sterling fund transfers originated by banks. CHAPS is frequently used by businesses for high-value payments to suppliers, by mortgage lenders issuing advances, and by solicitors and conveyancers on behalf of individuals buying houses. Then CHIPS, CHIPS. CHIPS is the largest private sector US dollar fund transfer system in the world. CHIPS operates on a global business day and utilizes a sophisticated liquidity savings mechanism to provide fast final payments while maximizing liquidity efficiency for participating banks. SFMS, Structured Financial Messaging System, SFMS, is a secure messaging standard developed to serve as a platform for intra-bank and inter-bank applications. It is an Indian standard similar to SWIFT, that is Society for Worldwide Interbank Financial Telecommunication, which is the international messaging system used for financial messaging globally. SFMS can be used practically for all purposes of secure communication within the bank and between banks. The SFMS was launched in 2001. RBI applications like real-time gross settlement, that is RTGS, negotiated dealing system, that is NDS, security settlement system, SSS, and integrated accounting system, IAS, delivery versus payment, DVP, centralized fund management system, CFMS, etc. have interfaced with SFMS, and RTGS uses SFMS for messaging. SWIFT. The Society for Worldwide Interbank Financial Telecommunication, SWIFT, provides a network that enables financial institutions worldwide to send and receive information about financial transactions in a secure, standardized, and reliable environment. The majority of international interbank messages use the SWIFT network. As of September 2010, SWIFT linked more than 9,000 financial institutions in 209 countries and territories. SWIFT transports financial message in a highly secure way but does not hold accounts for its members and does not perform any form of clearing or settlement. SWIFT does not facilitate fund transfer. Rather, it sends payment orders which must be settled by correspondent accounts that the institutions have with each other. SWIFT is a cooperative society under Belgian law and it is owned by its member financial institutions. NEFT system. Reserve Bank of India has introduced an electronic fund transfer system called National Electronic Fund Transfer Systems. The objective of NEFT system is to establish an electronic fund transfer system to facilitate an efficient, secure, economical, reliable, and expeditious system of funds transfer and clearing in the banking sector throughout India and to relieve the stress on the existing paper-based funds transfer and clearing system. National Electronic Fund Transfer and Real-Time Gross Settlement (RTGS) allow individuals, companies, and firms to transfer funds from one bank to another. These facilities can only be used for transferring money within the country. There is no ceiling on the minimum or maximum amounts that can be transferred through NEFT. You can even transfer rupee 1. However, a minimum of rupees 2 lakhs must be transferred through the RTGS service. There is no cap on the maximum amount, though. However, banks may restrict the amounts you can transfer in one day. NEFT operates on a deferred net settlement DNS basis and settles transactions in batches. The settlement takes place with all transactions received till a particular cutoff time. It operates in hourly batches. There are 11 settlements on weekdays and 5 on Saturdays. Any transaction initiated after the designated time would have to wait till the next settlement time. In RTGS, transactions are processed continuously all through the business hours. Here, transfers made are quick and can be helpful in emergencies. Question number 103. Which of the following ministries, along with the Planning Commission of India, has decided to set up a corpus fund of rupees 500 crores so that the tribals in the Naxal hit areas can be provided proper means of livelihood? A. Ministry of Rural Development. B. Ministry of Home Affairs. C. Ministry of Tribal Affairs. D. Ministry of Corporate Affairs. E. Ministry of Finance. Here, the discussion is oriented towards tribes and the Naxal hit areas. A social division in a traditional society consisting of families or communities linked by social, economic, religious, or blood ties with a common culture and dialect, typically having a recognized leader, is known as a tribe. A tribe is viewed historically or developmentally as a social group existing before the development of or outside the states. Many people use the term tribal society to refer to societies organized largely on the basis of social, especially familial descent groups. A customary tribe in these terms is a face-to-face community relatively bound by kinship relations reciprocal exchange, and strong ties to place. Tribe is a contested term due to its roots in colonialism. The word has no shared referent, whether in political form, kinship relations, or shared culture. Some argue that it conveys a negative connotation of a timeless, unchanging past. To avoid these implications, some have chosen to use the terms ethnic group or nation instead. In some places, such as North America and India, tribes are polities that have been granted legal recognition and limited autonomy by the state. Now we come to Naxal hit areas. A Naxal or an Naxalite is a member of any of the communist guerrilla groups in India, mostly associated with Communist Party of India, Maoist. The term Naxal derives from the name of the village Naxalbari in West Bengal, where the movement had its origin. Naxalites are considered far-left radical communists supportive of Maoist political sentiment and ideology. Their origin can be traced to 1967. Initially, the movement had its center in West Bengal. In later years, it spread to less developed areas of rural southern and eastern India such as Chhattisgarh, Odisha and Andhra Pradesh through the activities of underground groups like the Communist Party of India, Maoist. In 2006, India's intelligence agency, the Research and Analysis Wing, estimated that 20,000 armed cadre Naxalites were operating in addition to 50,000 regular cadres, and their growing influence prompted Indian Prime Minister to declare them to be the most serious internal threat to India's national security. Naxalites and other anti-government militants are often referred to as ultras. In February 2009, the Indian government announced a new nationwide initiative to be called the Integrated Action Plan (IAP) for broad coordinated operations aimed at dealing with Naxalite problem in all affected areas, namely Karnataka, Chhattisgarh, Odisha, Andhra Pradesh, Maharashtra, Jharkhand, Bihar, Uttar Pradesh and West Bengal. Importantly, this plan included funding for grassroots economic development projects in Naxalite affected areas, as well as increased special police funding for better containment and reduction of Naxalite influence in these areas. In 2009, Naxalites were active across approximately 180 districts in 10 states of India. In August 2010, after the first full year of implementation of the national IAP program, Karnataka was removed from the list of Naxalite affected states. In July 2011, the number of Naxalite affected areas was reduced to 83 districts in 9 states, including 20 additional districts. In December 2011, the national government reported that the number of Naxalite-related deaths and injuries nationwide had gone down by nearly 50% from 2010 levels. Communist terrorist groups, that is Naxals, are by far the most frequent perpetrators and the main cause of deaths in India. Maoist communist groups claim responsibility for 192 deaths in 2013, which was nearly half of all deaths from terrorism in India. Government has identified 26 districts in the country as highly Naxal affected, with 80% violence in the last 3 years being reported from there. The districts are spread over 7 Maoist hit states, namely Chhattisgarh, Jharkhand, Odisha, Bihar, Andhra Pradesh, Maharashtra and West Bengal. The Red Corridor is a region in the east of India that experiences considerable Naxalite Maoist insurgency. The Naxalite group mainly consists of the armed cadres of Communist Party of India, Maoist. These are also areas that suffer from the greatest illiteracy, poverty and overpopulation in the modern India and span parts of Andhra Pradesh, Bihar, Chhattisgarh, Jharkhand, Madhya Pradesh, Odisha, Telangana, Uttar Pradesh and West Bengal states. All forms of Naxalite organizations have been declared as terrorist organizations under the Unlawful Activities Prevention Act of India 1967. Question number 104. Which of the following was the issue over which India decided to vote against Sri Lanka in the meeting of one of the UN governed bodies or agencies? A. Violations of human rights in Sri Lanka, allowing China to establish a military base in Indian Ocean, issue of subsidy on agricultural products in the meeting of the WTO, allowing part of Sri Lanka to become an independent country governed by LTTE, Sri Lanka's claim to become a parliament member of UN Security Council. Sri Lanka, officially the Democratic Socialist Republic of Sri Lanka, is an island country in the northern Indian Ocean off the southeast coast of the Indian subcontinent in South Asia. Known until 1972 as Ceylon, Sri Lanka has maritime borders with India to the northwest and Maldives to the southwest. Sri Lanka has a documented history that spans over 3,000 years. Its geographic location and deep harbors made it of great strategic importance from the time of the ancient Silk Road through to World War II. Sri Lanka is a diverse country, home to many religious ethnicities and languages. Sri Lanka has a rich Buddhist heritage, and the first known Buddhist writings of Sri Lanka, the Pali Canon, dates back to the 4th Buddhist Council in 29 BCE. The country's recent history has been marred by a 30-year civil war, which was decisively ended when Sri Lankan military defeated Liberation Tigers of Tamil Eelam, that is LTTE, in 2009. Sri Lanka is a republic and a unitary state governed by a presidential system. The capital, Sri Jayawardhanepura Kotte, is a suburb of the largest city, Colombo. It is also an important producer of tea, coffee, gemstones, coconuts, rubber and the native cinnamon. The island contains tropical forests and diverse landscapes with a high amount of biodiversity. The country has had a long history of international engagement as a founding member of the SAARC and a member of the United Nations, the Commonwealth of Nations, the G77 and the Non-Aligned Movement. It is the only country in South Asia that is currently rated high on the Human Development Index. Officially, the Constitution of Sri Lanka guarantees human rights as ratified by the United Nations. However, human rights in Sri Lanka have come under criticism by the Amnesty International, Freedom from Torture and Human Rights Watch, as well as the United States Department of State British colonial rulers, the separatist liberation tigers of Tamil Eelam and the government of Sri Lanka are accused of violating human rights. A report by an advisory panel to the UN Secretary General has accused both the LTTE and the Sri Lankan government of alleged war crimes during final stages of the civil war. The string of pearls theory is a geopolitical theory regarding potential Chinese intentions in the Indian Ocean region. It refers to the network of Chinese military and commercial facilities and relationships along its sea lines of communication which extend from the Chinese mainland to Port Sudan. Port Sudan is a port city in Sudan and the capital of the state of Red Sea. It has a population of 5 lakh residents. Located on the Red Sea, it is the Republic of Sudan's main port city. The sea lines run through several maritime choke points such as the Strait of Mandeb, the Strait of Malacca, the Strait of Hormuz and the Lombok Strait, as well as other strategic maritime centers in Pakistan, Sri Lanka, Bangladesh, the Maldives and Somalia. The term as a geopolitical concept was first used in an internal United States Department of Defense report titled Energy Futures in Asia. The term has never been used by official Chinese government sources, but is often used in the Indian media. Maritime transit choke points are narrow channels along widely used global sea routes. Because about 1/2 of the world's crude oil supply is moved by tankers on maritime shipping routes, world oil transport choke points are a critical part of global energy security. Maritime choke points or oil choke points are congestive pathways in some of the world's famous shipping routes. There are many such choke points around the world. However, a few of them are extremely famous for ships and thus face high international security conflicts and cross-border terrorism threats. As maritime choke points are located at indispensable marine trade routes, in case of global security problems, avoiding these choke points has often been suggested as a workable option. However, since avoiding these maritime choke points of the world would contribute to a huge loss in the nature of oil freight shipping operations, majority of the oil shipping operations are still carried out by navigating through them. Some of the famous maritime choke points around the world are the Malaccan Strait in the Indian Ocean, the Gulf of Hormuz in the Middle East, the Suez Canal linking the Mediterranean and the Red Sea, the Panama Canal linking the Atlantic with the Pacific Ocean, the Strait of Bosphorus, the Turkish Strait linking the Mediterranean Sea to the Black Sea, the 3 Danish straits linking the Baltic Sea with the North Sea, the Strait of Bab el-Mandeb forming a gateway for vessels to pass through the Suez Canal through the east coast of Africa. The above mentioned 7 maritime choke points have gained immense ill fame in the past and in the present times, especially because of the heavy geopolitical pressure surrounding them. Bab el-Mandeb is a strait located between Yemen and Arabian Peninsula and Djibouti and Eritrea in the Horn of Africa. It connects the Red Sea to the Gulf of Aden. It is sometimes called the Mandeb Straits in the English language. The Bab-el-Mandeb acts as a strategic link between the Indian Ocean and the Mediterranean Sea via the Red Sea and the Suez Canal. The Strait of Malacca or Straits of Malacca is a narrow 805 km stretch of water between Malay Peninsula and the Indonesian island of Sumatra. The Strait of Hormuz is a strait between the Gulf of Oman and the Persian Gulf. It is the only sea passage from the Persian Gulf to the open ocean and is one of the world's most strategically important choke points. On the north coast is Iran and on the south coast is the United Arab Emirates and Mazundam and exclave of Oman. At its narrowest, the strait is 21 nautical miles wide. About 20% of the world's petroleum and about 35% of the petroleum traded by sea passes through the strait, making it a highly important strategic location for the international trade. The Lombok Strait is a strait connecting the Java Sea to the Indian Ocean and is located between the islands of Bali and Lombok in Indonesia. Its narrowest point is at its southern opening with a widest width of about 20 km between the islands of Lombok and Nusa Penida in the middle of the strait. At the northern opening, it is 40 km across. Its total length is about 60 km. Because it is 250 meters deep, much deeper than the Strait of Malacca, ships that draw too much water pass through Malacca. The so-called post-Malacca marks vessels often use the Lombok Strait instead. The Lombok Strait is notable as one of the main passages for the Indonesian through flow that exchanges water between the Indonesian and the Pacific Ocean. It is also the part of a biographical boundary between the fauna of Indo-Malaya ecozone and the distinctly different fauna of Australia or Australasia. The boundary is known as the Wallace Line for Alfred Russel Wallace, who first remarked upon the striking difference between the animals of Indo-Malaysian from those of Australasia and how abrupt the boundary was between the two homes. The emergence of string of pearls is indicative of China's growing geopolitical influence through concerted efforts to increase access to ports and airfields, expand and modernize military force, and foster stronger diplomatic relationships with trading partners. The Chinese government insists that China's burgeoning naval strategy is entirely peaceful in nature and designed solely for the protection of regional trade interests. In a move that may cause unease in India, China announced that it will set up its first military base abroad in an Indian Ocean island, Seychelles, to seek supplies and recuperate facilities for its navy. The naval fleet may seek supplies or recuperate at appropriate harbors in Seychelles or other countries as needed during the escort missions. Chinese Defense Ministry announced here. China has already cemented its foothold in the Indian Ocean by signing contract with the UN-backed International Seabed Authority to gain rights to explore polymetallic sulfide ore deposit in the Indian Ocean over the next 15 years. We now come to discuss about Security Council. The UN Charter established 6 main organs of the United Nations, including the Security Council. It gives primary responsibility for maintaining international peace and security to the Security Council, which may meet whenever peace is threatened. According to the Charter, the United Nations has 4 purposes: to maintain international peace and security, to develop friendly relationship among the nations, to cooperate in solving international problems and in promoting respect for human rights, and to be a center for harmonizing the actions of nations. All members of the United Nations agree to accept and carry out the decisions of the Security Council, while the other organs of the United Nations make recommendations to the member states. Only the Security Council has the power to make decisions that the member states are then obliged to implement under the Charter. The Council may opt for enforcement measures, including economic sanctions, arms embargoes, financial penalties and restrictions, and travel bans, severance of diplomatic relationships, blockade, or even collective military action. The Security Council held its first session on 17 January 1946 at London. Now, the Security Council is located at the United Nations headquarters in New York City. It also traveled to many cities, including holding sessions in Addis Ababa, Ethiopia in 1972, in Panama City, Panama, and in Geneva, Switzerland in 1990. A representative of each of its members must be present at all times at UN headquarters so that the Security Council can meet at any time as the need arises. Question number 105. Smart money. Cash invested or wagered by those considered to be experienced, well-informed, in the know, or all the three. Although there is little empirical evidence to support the notion that smart money investments perform any better than non-smart money investments do, many speculation methods take such influxes of cash very seriously. Because insiders and better informed speculators typically invest more, smart money can sometimes be spotted by greater than usual volume, especially when little or no public data exists to justify it. Knowing who the smart money is and when and where they are investing can be a great benefit to retail investors who want to ride the smart money coattails. The funds controlled by investors who should have special knowledge of the right kinds of investments to make. Essentially, the term refers to funds controlled by insiders or to institutional money. The implication is that if the individual investor can figure out where the smart money is going, he or she can follow suit and make above average profits. Many researchers believe that smart money is no more likely to earn above average returns than funds invested by typical investors. Many analysts, however, dispute the idea that smart money is any smarter than that of the average investor. The United States dollar is the official currency of the United States and its overseas territories. It is a Federal Reserve note and consists of 100 smaller cent units. The US dollar is a fiat money. It is the currency most used in international transactions and is the world's most dominant reserve currency. Several countries use it as their official currency, and in many others it is the de facto currency. Besides the United States, it is also used as the sole currency in two British overseas territories, that is the British Virgin Islands and the Turks and Caicos Islands. US dollar has several nicknames. They are bill, bean, buck, paper, smackaroo, ducat, doubloon, dead president, smacker, and greenback. In plural, they are used as dough, green, bread, bones, bananas, bucks, skrilla, bank clams. Also, they are called Washingtons, Jeffersons, Lincolns, Jacksons, Benjamins, Grants, and Hamiltons are used based on the denomination. Traveler's check, a medium of exchange that can be used in place of hard currency. Traveler's checks are often used by individuals who are traveling on vacation to foreign countries. The checks were first introduced by American Express back in 1891. Traveler's checks provide a safe way to carry currency abroad. Security is provided against lost or stolen checks by the issuing party, usually a bank. Specific checks are given unique check numbers similar to a normal check. When a lost or stolen check is identified, it is simply cancelled and the individual is reissued a new check. Although banks issue the checks directly to individuals, they are produced by a separate party. A traveler's check is pre-printed, fixed amount check designed to allow the person signing it to make an unconditional payment to someone else as a result of having paid the issuer for that privilege. They were generally used by people on vacation instead of cash, as many businesses used to accept travelers' checks as currency. Merchants and other parties would accept them as if they were currency because as long as the original signature, which the buyer is supposed to place on the check in ink as soon as he or she receives the checks, and the signature made at the time of check is the same, the traveler's check issuer will unconditionally guarantee payment of the face amount even if the check is fraudulently issued, was stolen, or lost. In short, a traveler's check can never bounce unless the issuer goes bankrupt and out of business. If a traveler's check were lost or stolen, it could be replaced by the issuing institution. The use has been in decline since 1990s as alternatives such as credit cards, debit cards, and automatic teller machines became more widely available and were easier and more convenient for travelers. Traveler's checks are no longer widely accepted and cannot easily be cashed even at the banks that issue the checks. A credit card is a payment card issued to users as a system of payment. It allows the cardholder to pay for goods and services based on the holder's promise to pay for them. The issuer of the card creates a revolving account and grants a line of credit to the consumer or the user, from which the user can borrow money for payments to a merchant or as a cash advance to the user. A credit card is different from a charge card. A charge card requires the balance to be paid in full each month. In contrast, credit cards allow the consumers a continuing balance of debt subject to interest being charged. A credit card also differs from a cash card, which can be used like currency by the owner of the card. A credit card differs from a charge card also in that a credit card typically involves a third-party entity that pays the seller and is reimbursed by the buyer, whereas the charge card simply defers payment by the buyer until a later date. The size of most credit cards is 3 3/8 inch into 2 1/8 inch, that is 85.60 mm by 53.98 mm, conforming to the ISO standard. Credit cards have a printed or embossed bank card number complying with the ISO numbering standard. Both these standards are maintained and further developed by ISO. Question number 106. Which one of the following is not a money market instrument? Treasury bills, commercial paper, certificate of deposit, equity shares, and none of these. The answer is equity shares. Now we will try to understand what all these terms mean. Money market. As money becomes a commodity, the money market became a component of the financial markets for assets involved in short-term borrowing, lending, buying and selling with original maturities of over 1 year or less. Trading in the money markets is done over the counter and is wholesale. Various instruments exist such as treasury bills, commercial paper, bankers' acceptances, deposits, certificates of deposits, bills of exchange, repurchasing agreements, federal funds, and short-lived mortgage and asset-backed securities. It provides liquidity funding for the global financial system. Money markets and capital markets are parts of financial markets. The instruments bear differing maturities, currencies, credit risks, and structure. Therefore, they may be used to distribute the exposure. Money market instruments. In the financial marketplace, a distinction is made between the capital markets and the money markets. The capital market is a source of intermediate term to long-term financing in the form of equity or debt securities with maturities of more than 1 year. The money market provides very short-term funds to corporations, municipalities, and the government. Money market securities are debt issues with maturities of 1 year or less. Characteristics. Money market instruments give businesses, financial institutions, and governments a means to finance their short-term cash requirements. 3 important characteristics are liquidity. Since they are fixed income securities with short-term maturities of a year or less, money market instruments are extremely liquid. Safety. They also provide a relatively high degree of safety because of their issuers have the highest credit ratings. Discount pricing. A third characteristic they have in common is that they are issued at a discount to their face value. The money market is the arena in which financial institutions make available to a broad range of borrowers and investors the opportunity to buy and sell various forms of short-term securities. There is no physical money market. Instead, it is an informal network of banks and traders linked by telephones, fax machines, and computers. Money markets exist all over the world. The short-term debts and securities sold on the money markets, which are known as money market instruments, have maturities ranging from 1 day to 1 year and are extremely liquid. Treasury bills, certificates of deposits, commercial paper, bankers' acceptances, and repurchase agreements are examples of instruments. The suppliers of funds for money market instruments are institutions and individuals with a preference for the highest liquidity and the lowest risk. The money market is important for businesses because it allows companies with a temporary cash surplus to invest in short-term securities. Conversely, companies with a temporary cash shortfalls can sell securities or borrow funds on a short-term basis. In essence, the market acts as a repository for short-term funds. Large corporations generally handle their own short-term financial transactions. They participate in the market through dealers. Small businesses, on the other hand, often choose to invest in money market funds, which are professionally managed mutual funds consisting only of short-term securities. Although securities purchased on the money market carry less risk than long-term debt, they are still not entirely risk-free. After all, banks do sometimes fail, and the fortunes of companies can change rather rapidly. The low risk is associated with lender selectivity. The lender who offers funds with almost instant maturities, that is tomorrow, cannot spend too much time qualifying borrowers and thus selects only blue chip borrowers. Repayment, therefore, is assured unless you caught Enron just before it suddenly nosedived. Borrowers with fewer credentials, of course, have difficulty getting money from this market unless it is through well-established funds. Types of money market instruments. Certificates of deposits. Certificates of deposit, that is CDs, are certificates issued by a bank against deposited funds that earn a specified return for a definite period of time. They are one of several types of interest-bearing time deposits offered by banks. An individual or company lends the bank a certain amount of money for a fixed period of time, and in exchange, the bank agrees to repay the money with specified interest at the end of the time period. The certificate constitutes the bank's agreement to repay the loan. The maturity rates on CDs range from 30 days to 6 months or longer, and the amount of the face value can vary greatly as well. There is usually a penalty for early withdrawal of funds, but some types of CDs can be sold to another investor if the original purchaser needs access to the money before the maturity date. Commercial paper. Commercial paper refers to an unsecured short-term promissory notes issued by a financial and non-financial corporations. Commercial paper has maturities of up to 270 days. Unlike some other types of money market instruments in which banks act as intermediaries between buyers and sellers, commercial paper is issued directly by well-established companies as well as by financial institutions. Banks may act as agents in the transaction, but they assume no principal positions and are in no way obligated with respect to repayment of the commercial paper. Companies may also sell commercial paper through dealers who charge a fee and arrange for the transfer of the funds from the lender to the borrower. Commercial paper, that is CP, an unsecured money market instrument issued in the form of a promissory note, was introduced in India in 1990 with a view to enable highly rated corporate borrowers to diversify their sources of short-term borrowing and provide an additional instrument to the investors. A corporate would be eligible to issue a CP provided the tangible net worth of the company as per the latest audited balance sheet is not less than rupees 4 crores. Company has been sanctioned working capital limit by banks or All India financial institutions. And the borrowal account of the company is classified as a standard asset by the financing bank or institution. All eligible participants shall obtain the credit rating for the issuance of commercial paper either from Credit Rating Information Services of India Limited, that is CRISIL, or the Investment Information and Credit Rating Agency of India Limited, that is ICRA, or the Credit Analysis and Research Limited, that is CARE, or the Fitch Ratings India Private Limited, or such other credit rating agencies which are called CRA, as may be specified by the Reserve Bank of India from time to time for the purpose. The minimum credit rating shall be A2 as prescribed by the Securities and Exchange Board of India, SEBI. The issuer shall ensure at the time of issuance of CP that the rating so obtained is current and has not fallen due for review. CP can be issued for maturities between a minimum of 7 days and a maximum up to 1 year from the date of issue. However, the maturity date of the CP should not go beyond the date up to which the credit rating of the issuer is valid. Commercial paper in the global financial market is an unsecured promissory note with a fixed maturity of no more than 270 days. Commercial paper is a money market security sold by large corporations to obtain funds to meet short-term debt obligations, for example payroll, and is backed only by an issuing bank or corporation's promise to pay the face amount on the maturity date specified on the note. Since it is not backed by collateral, only firms with excellent credit ratings from a recognized credit rating agency will be able to sell their commercial paper at a reasonable price. Commercial paper is usually sold at a discount from face value and carries higher interest repayment rates than bonds. Typically, the longer the maturity on a note, the higher the interest rate the issuing institution pays. Interest rates fluctuate with market conditions but are typically lower than bank rates. Commercial paper, though a short-term obligation, is issued as a part of continuous or rolling program which is either a number of years long as in Europe or open-ended as in the US. Repurchase agreements. Repurchase agreements, also known as repos or buybacks, or treasury securities that are purchased from a dealer with the agreement that they will be sold back at a future date for a higher price. These agreements are the most liquid of all money market investments, ranging from 24 hours to several months. In fact, they are very similar to bank deposit accounts, and many corporations arrange for their banks to transfer excess cash to such funds automatically. Treasury bill. Treasury bills are instruments of short-term borrowing by the Government of India issued as promissory notes under discount. The interest received on them is a discount, which is the difference between the price at which they are issued and the redemption value. They have assured yield and negligible risk of default. Under one classification, treasury bills are categorized as ad hoc, tap, and auction bills, and under another classification, it is classified on the maturity period like 91 days TVs, 182 days TVs, 364 days TVs, and two types of 10 days TVs. In the recent times, the Reserve Bank of India has been issuing only 91-day and 364-day treasury bills. The treasury bills sold to the public and banks are called regular treasury bills. They are freely marketable. Commercial banks buy entire quantity of such bills issued or tender. They are bought and sold on discount basis. Ready forward contract, repos. Repo is an abbreviation for repurchase agreement which involves a simultaneous sale and purchase agreements. When the banks have any shortage of funds, they can borrow it from Reserve Bank of India or from other banks. The rate at which the RBI lends money to the commercial banks is called the repo rate, a short term for repurchase agreement. A reduction in the repo rate will help banks to get money at a cheaper rate. When the repo rate increases, borrowing from RBI becomes more expensive. Call money market. The call money market deals in the short-term finance repayable on demand with a maturity period varying from 1 day to 14 days. Commercial banks, both Indian and foreign, cooperative banks, Discount and Finance House of India Limited, Securities Trading Corporation of India participate as both lenders and borrowers, and Life Insurance Corporation of India, Unit Trust of India, National Bank for Agriculture and Rural Development (NABARD) can participate only as lenders. The interest rate paid on call money loans, known as the call rate, is highly volatile. It is the most sensitive section of the money market, and the changes in the demand for and supply of call loans are promptly reflected in call rates. There are now two call rates in India: the interbank call rates and the lending rate of DFHI. The ceilings on the call rate and the interbank term money rate were dropped with effect from May 1st, 1989. The Indian call money market has been transformed into a pure interbank market now. The major call money markets are in Mumbai, Kolkata, Delhi, Chennai, and Ahmedabad. A certificate of deposit is a time-bound financial commodity sold by banks, credit institutions, and credit unions. CDs are similar to savings bank accounts in that they are insured and are virtually risk-free. They are money in the bank. They are different from the savings accounts in that the CDs has a specific fixed term, often monthly, 3 months, 6 months, or 1 to 5 years, and usually a fixed interest rate. It is intended that the CD be held until maturity, at which time the money may be withdrawn together with the accrued interest. In exchange for keeping money on deposit for the agreed term, institutions usually grant higher interest rates than they do on account from which money may be withdrawn on demand, although this may not be the case in an inverted yield curve situation. Sometimes CDs that are indexed to the stock market, the bond market, or other indices are introduced. A few general guidelines for interest rates are: a large principal should receive a higher interest rate but may not. A longer term will usually receive a higher interest rate except in the case of an inverted yield curve, that is, preceding a recession. Similar institutions tend to offer higher interest rates than larger ones. Personal CD accounts generally receive the higher interest rates than business CD accounts. Banks and credit unions that are not insured generally offer higher interest rates. Certificates of deposits is a negotiable money market instrument and is issued in dematerialized form or as a usance promissory note against funds deposited at a bank or other eligible financial institutions for a specified time period. Guidelines for issue of CDs are presently governed by various directives issued by the Reserve Bank of India as amended from time to time. The guidelines for issuance of CDs incorporating all the Reserve Bank amendments. The guidelines for issue of CDs incorporating all the amendments issued till date are given below for ready reference. CDs can be issued by scheduled commercial banks, excluding regional rural banks and local area banks, and select All India financial institutions that have been permitted by RBI to raise short-term resources within the umbrella of fixed by the Reserve Bank of India. Banks with the freedom to issue CDs depending on their funding requirements. Minimum amount of a CD should be Rs 1 lakh, that is the minimum deposit that could be accepted from a single subscriber should not be less than Rs 1 lakh and in multiples of 1 lakh thereafter. CDs can be issued to individuals, corporations, companies, including banks and PDs, trusts, funds, associations, etc. Non-resident Indians may also subscribe to CDs but only on non-repatriable basis, which should be clearly stated on the certificates. Such CDs cannot be endorsed to another NRI in the secondary market. The maturity period of CDs issued by banks should not be less than 7 days and not more than 1 year from the date of issue. The FIs can issue CDs for a period of not less than 1 year and not exceeding 3 years from the date of issue. CDs may be issued at a discount value. CDs may be issued at a discount on face value. Banks or FIs are allowed to issue CDs on floating rate basis, provided the methodology of compiling the floating rate is objective, transparent, and market-based. Banks have to maintain appropriate reserve requirements, that is, cash reserve ratio (CRR) and statutory liquidity ratio (SLR) on the issue price of the CDs. CDs in physical form are freely transferable by endorsement and delivery. There is no lock-in period for the CDs. In accounting and finance, equity is the residual value or interest of the most junior class of investors in assets. After all, liabilities are paid. If the liability exceeds assets, negative equity exists. In an accounting context, the shareholders' equity or stockholders' equity, shareholders' funds, shareholders' capital or similar terms represents the remaining interest in the assets of the company spread among individual shareholders of common or preferred stock. And negative shareholders' equity is often referred to as the positive shareholders' deficit. At the very start of a business, owners put some funding into the business to finance operations. This creates a liability on the business in the shape of capital, as the business is a separate entity from its owners. Businesses can be considered for accounting purposes. Sums of liabilities and assets. This is an accounting equation. After liabilities have been accounted for, the positive remainder is deemed the owner's interest in the business. Ownership equity is also known as risk capital or liable capital. An equity share, commonly referred to as an ordinary share, also represents the form of fractional or part ownership in which a shareholder, as a fractional owner, undertakes the maximum entrepreneurial risk associated with the business venture. The holders of such shares are members of the company and have voting rights. Question number 107. Which one of the following is a retail banking product? Home loans, working capital finance, corporate term loans, infrastructure financing, export credit. The answer is home loans. Let us understand what is meant by retail banking. Retail banking is when a bank executes transactions directly with consumers rather than corporations or other banks. Services offered include savings and transactional accounts, mortgages, personal loans, debit cards, and credit cards. The term is generally used to distinguish these banking services from investment banking, commercial banking, or wholesale banking. It may also be used to refer to a division of a bank dealing with retail customers and can also be termed as personal banking services. Typical products offered by a retail bank include transactional accounts, checking accounts, current accounts, savings accounts, debit cards, ATM cards, credit cards, traveler's checks, mortgages, home equity loans, personal loans, certificates of deposits, term deposits. Working capital is a financial metric which represents operating liquidity available to a business, organization or other entity, including governmental entity. Along with fixed assets such as plant and equipment, working capital is considered a part of operating capital. Gross working capital equals to current assets. Working capital is calculated as current assets minus current liabilities. If current assets are less than current liabilities, an entity has a working capital deficiency, also called working capital deficit. A company can be endowed with assets and profitability but short of liquidity if its assets cannot be readily be converted into cash. Positive working capital is required to ensure that a firm is able to continue its operations and that it has sufficient funds to satisfy both maturing short-term debt and upcoming operational expenses. The management of working capital involves managing inventories, account receivable and payable, and cash. Working capital finance is defined as the capital of a business that is used in its day-to-day trading operations, calculated as the current assets minus current liabilities. For many companies, this is wholly comprised of trade debtors, that is, bills outstanding, and trade creditors, bills the company in question has yet to pay. Factoring facilities are traditional sources of working capital. Factoring facility arrangements tend to be restrictive, and entering into a whole turnover factoring facility can lead to aggressive chasing of outstanding invoices from clients and a loss of control of a company's credit function. Despite the large numbers of providers of working capital finance, there is limited competition on pricing and structure of factoring facilities, primarily because all their funding comes from the same capital providers, that is, the commercial finance divisions of the major high street banks. There is some competition on service between the independents, but once a company has signed up for 18 months, there are significant switching costs and the factor effectively holds a monopoly over the business. Term loan. A loan from a bank for a specific amount that has a specified repayment schedule and a floating interest rate. Term loans almost always mature between 1 and 10 years. For example, many banks have term loan programs that can offer small businesses the cash they need to operate from month to month. Often, a small business will use the cash from a term loan to purchase fixed assets such as equipment used in its production process. A term loan is a monetary loan that is repaid in regular payments over a set period of time. Term loans usually last between 1 and 10 years, but may last as long as 30 years in some cases. A term loan usually involves an unfixed interest rate that will add additional balance to be repaid. Question number 108. Which of the following statements is true about political situation in Mali where a military coup burst out recently? General elections were due there in March-April 2012 but did not take place. The country was under the control of US Army since last 18 months. Army of the country was not happy as Amadou Touré was made president without elections for the next 5 years. Coup broke out in Mali when Amadou Touré, the military chief, got seriously injured in a bomb blast. NATO and its associates had planned a coup there. Mali, officially the Republic of Mali, is a landlocked country in West Africa. Mali is the 8th largest country in Africa with an area of just over 12,40,000 square kilometers. The population of Mali is 14.5 million. Its capital is Bamako. Mali consists of 8 regions and its borders on the north reach deep into the middle of the Sahara, while the country's southern part, where the majority of inhabitants live, features the Niger and the Senegal rivers. The country's economic structure centers on agriculture and fishing. Some of Mali's prominent natural resources include gold, being the third largest producer of gold in African continent, and salt. About half of the population live below the international poverty line of $1.25 a day. A majority of the population, that is 55%, are non-denominational Muslims. In January 2012, an armed conflict broke out in northern Mali, which Tuareg rebels took control of by April and declared the cessation of a new state, Azawad. The conflict was complicated by a military coup that took place in March and later fighting between Tuareg and Islamist rebels. In response to Islamist territorial gains, the French military launched Operation Serval in January 2013. A month later, Malian and French forces recaptured most of the north. Presidential elections were held on 28 July 2013, with a second round runoff held on 11 August, and legislative elections were held on 24th November 2013. Amadou Toumani Touré is also known as ATT, is a Malian politician who was president of Mali from 2002 to 2012. The North Atlantic Treaty Organization, NATO, also called the North Atlantic Alliance, is an intergovernmental military alliance based on the North Atlantic Treaty, which was signed in 1949. The organization constitutes a system of collective defense whereby its member states agree to mutual defense in response to an attack by an external party. NATO's headquarters are in Brussels, Belgium. An additional 22 countries participate in NATO's Partnership for Peace program, with 15 other countries involved in institutionalized dialogue programs. The combined military spending of all NATO members constitute over 70% of the global total. Members' defense spending is supposed to amount to 2% of GDP. After the fall of Berlin Wall in 1989, the organization was drawn into the breakup of Yugoslavia and conducted its first military interventions in Bosnia from 1992 to 1995 and later Yugoslavia in 1999. Politically, the organization sought better relations with former Warsaw Pact countries, several of which joined the alliance in 1999 and 2004. Article 5 of the North Atlantic Treaty, requiring member states to come to the aid of any member state subject to an armed attack, was invoked for the first and only time after the 11th September 2001 attacks, after which troops were deployed to Afghanistan under the NATO-led ISAF. Question number 109. In the summit of which of the following organizations bar group of nations, it was decided that members should enforce budget discipline? G8, OPEC, European Union, SAARC, G20. Budgetary discipline. Budgetary discipline in the European Union member states has been laid down in the Stability and Growth Pact since 1997. In response to the economic and financial crisis, the EU adopted new policy in 2010 that came into force in 2011. The rules on budgetary discipline have been reinforced. Agreements have been made on surveillance of the macroeconomic situation in the member states, and the European semester has been introduced to coordinate economic priorities, the budgetary rules, and the new macroeconomic surveillance. The pact of agreements between the member states on the maximum levels of their government deficits and government debts. It consists of a preventive arm and a corrective arm. At present, the government deficit and the government debt of the Netherlands are higher than the agreed maximum levels. The Netherlands has an excessive deficit. The Group of 8, G8, is the name of a forum for the governments of a group of 8 leading advanced economies that was originally formed by 6 leading industrialized countries and subsequently extended with 2 additional members, that is Canada and the European Commission. Russia, which was invited to join as a G8 nation, was excluded from the forum by the other members on 24th March 2014 as a result of its involvement in the 2014 Crimea crisis in Ukraine. Thus, the group will continue to meet comprising of 7 nations and the EU. The forum originated with a 1975 summit leading to the name Group 6 or G6. The summit became known as a Group of 7 or G7 in 1976. Russia was added to the group from 1998 to 2014, which then became known as a G8. Each calendar year, the responsibility of hosting the G8 is rotated through the member states. OPEC, OPEC, Organization of the Petroleum Exporting Countries, is an international organization and economic cartel whose mission is to coordinate the oil production policies of its members in order to secure a steady income for them all. OPEC is an intergovernmental organization that was created at Baghdad Conference on 10 to 14 September 1960. OPEC was headquartered in Geneva, Switzerland before moving to Vienna in September 65. In 1970s, OPEC began to gain influence and steeply raised oil prices during the 1973 oil crisis in response to the U.S. aid to Israel in the 1980s. The price of oil was allowed to rise before the adverse effects of higher prices caused demand and the price to fall. Lower demand for oil saw the price of oil fall back to 1986 levels by 1998-99. In the 2000s, a combination of factors pushed up the oil prices even as supply remained high. Prices rose then record high levels in mid-2008 before falling in response to the 2007 financial crisis. OPEC's objective is to coordinate and unify petroleum policies among member countries in order to secure fair and stable prices for petroleum producers, that is, an efficient, economic and regular supply of petroleum to consuming nations, and a fair return on capital to those investing in the industry. The international oil market was dominated by the 7 sisters multinational companies and was largely separate from that of the former Soviet Union and other centrally planned economies. According to New York Times, the oil drilling boom in the United States has increased oil production by over 70% since 2008 and has reduced the United States oil imports from OPEC by 50%. Since 2011, the United States absorbed the rapidly increased domestic production of sweet, light, tight oil by reducing like-for-like of similar grade imported crude oil from Nigerian and other African suppliers. In 2011, the United States imported 1.7 million barrels per day. In January and February of 2014, light crude imports to United States averaged only 0.6 million barrels per day. In June 2014, crude oil prices abruptly dropped by about a third as U.S. shale oil production increased and China and Europe's demand for oil decreased. Nigeria is the largest producer of sweet oil in OPEC. By July 2014, as the U.S. stopped importing light sweet crude, more crude oil became available to refineries in China, India, Japan, and South Korea. They collectively purchased 42% more Nigerian crude in 2014 compared with 2013. By 11th December 2014, the price of OPEC reference basket of crude has dropped to $60.50, and by 13th December, the price of Brent ICE dropped to $61.85. The European Union is a politico-economic union of 28 member states that are located primarily in Europe. The European Union operates through a system of supranational institutions and intergovernmental negotiated decisions by the member states. The European Parliament is elected every 5 years by European Union citizens. The European Union has developed a single market through a standardized system of laws that apply in all member states. Within the Schengen area, passport controls have been abolished. EU policies aim to ensure the free movement of people, goods, services, and capital, enact legislation in justice and home affairs, and maintain common policies on trade, agriculture, fisheries, and regional development. The Monetary Union was established in 1999 and came into full force in 2002. It is currently composed of 18 member states that use the euro as their legal tender. Through the common foreign and security policy, the European Union has developed a role in external relations and defense. The Union maintains permanent diplomatic missions throughout the world and represents itself at the United Nations, the World Trade Organization, the G8, and the G20. With a combined population of over 500 million inhabitants, or 7.3% of the world population, in 2012, the European Union was awarded the Nobel Peace Prize. The European Union was created in the aftermath of the Second World War. The South Asian Association for Regional Cooperation, SAARC, SAARC, is an economic and geopolitical organization of 8 countries that are primarily located in South Asia. The SAARC Secretariat is based in Kathmandu, Nepal. The combined economy of SAARC is third largest in the world in terms of GDP after the United States and China, and the eighth largest in terms of nominal GDP. SAARC nations comprise 3% of the world's area, and in contrast having 21%, that's about 1.7 billion of the world's total population. India makes up over 70% of the area and population among these 8 nations. India accounts for nearly 80% of SAARC's economy. The idea of regional political and economical cooperation in South Asia was first raised in 1980, and the first summit was held in Dhaka on 8th December 1985. The SAARC policies aim to promote welfare economics, collective reliance among the countries of South Asia, and to accelerate socio-cultural developments in the region. The 18th SAARC summit was held in Kathmandu in November 2014. The G20, also known as the Group of 20 and occasionally the G21, G23 or G20 plus, is a bloc of developing nations established in August 2003. The G20 accounts for 60% of the world's population and 70% of its farmers and 26% of the world's agricultural exports. The G20 is an international forum for the governments and central governors from the 20 major economies. The members shown highlighted on the members include 19 individual countries and the European Union also. The G20 is the latest in a series of initiatives aimed at international coordination of economic policy. The G20 is the latest in a series of initiatives aimed at international coordination of economic policy, which have been prominent since the efforts during the World War II to create some form of international or global economic governance, including through the Bretton Woods twins, the International Monetary Fund and the World Bank, and now what is known as World Trade Organization. Collectively, the G20 economies accounts for around 85% of the gross world product, 80% of the world trade, or if excluding EU intra-trade, 75%, and 2/3 of the world population. The G20 heads of governments or heads of state have periodically conferred at summits since their initial meeting in 2008. The group was formally inaugurated in September 1999. In December 2014, Turkey took over the presidency of G20 from Australia, and it will host the Antalya Summit in 2015. Number 110. As per newspaper reports, India is planning to use SEU as fuel in its 700 MV nuclear reactors being developed in new plants. What is the full form of SEU as used here? The options are safe electrical units, small electrical units, slightly enriched uranium, sufficiently enriched units, safely enriched uranium. The answer is slightly enriched uranium. Let us understand what this enriched uranium is all about. Enriched uranium is a type of uranium in which the percent of composition of uranium-235 has been increased through the process of isotope separation. Natural uranium is 99.284% 238U isotope, with 235U only constituting about 0.711% of its weight. 235U is the only nuclide existing in nature in any appreciable amount that is fissile with thermal neutrons. Enriched uranium is a critical component of both civil nuclear power generation and military nuclear weapons. The International Atomic Energy Agency attempts to monitor and control enriched uranium supplies and processes in its efforts to ensure nuclear power generation safety and curb nuclear weapons proliferation. During the Manhattan Project, enriched uranium was given the code name Oralloy, a shortened version of Oak Ridge alloy, after the location of the plants where the uranium was enriched. The term OR alloy is still occasionally used to refer to enriched uranium. There are about 2,000 tons of highly enriched uranium in the world, produced mostly for nuclear weapons, naval propulsion, and smaller quantities for research reactors. The 238U remaining after enrichment is known as depleted uranium and is considerably less radioactive than even natural uranium. At present, 95% of the world's stock of depleted uranium remain in secure storage. Slightly enriched uranium, SEU. Slightly enriched uranium has a 235U concentration of 0.9% to 2%. This new grade can be used to replace natural uranium fuel in some heavy water reactors like we can do. Fuel designed with SEU could provide additional benefits such as safety improvements or operational flexibility, etc. Normally, the benefits were considered in safety area while retaining the same operational envelope. Reprocessed uranium, REPU. Reprocessed uranium, REPU, is a product of nuclear fuel cycles involving nuclear reprocessing of spent fuel. REPU recovered from light water reactor LWR spent fuel typically contains slightly more uranium-235 than natural uranium and therefore could be used to fuel reactors that customarily use natural uranium as fuel, as CANDU reactors. Low enriched uranium. Low enriched uranium, LEU, has a lower than 20% concentration of 235 uranium. For use in commercial light water reactors, the most prevalent power reactors in the world, uranium is enriched to 3 to 5% 235 uranium. Fresh LEU used in research reactors usually enriched 12% to 19.75% uranium-235. The latter concentration being used to replace HEU fuels when converting to LEU. Highly enriched uranium, that is HEU, has a greater than 20% concentration of 235U or 233U. The very first uranium bomb, Little Boy, nicknamed Little Boy, dropped by the United States on the Hiroshima in 1845, used 64 kilograms of 80% enriched uranium. The critical mass for 85% highly enriched uranium is about 50 kilograms, which at normal density would be sphere about 17 centimeters in diameter. Later stage nuclear weapons usually use plutonium-239 in the primary stage, but the secondary stage, which is compressed by the primary nuclear explosion, often uses highly enriched uranium with enrichment between 40% and 80%, along with the fusion fuel lithium deuteride. HEU is also used in fast neutron reactors whose cores require about 20% or more fissile material, as well as in naval reactors, where it often contains at least 50% 235 uranium, but typically does not exceed 90%. Question number 111. Technological advancement in the recent times have given a new dimension to banks, mainly to which one of the following aspects? Options are new age financial derivatives, services delivery mechanism, any banking, any type banking, multi-level marketing. We'll try to understand the various terms used in this question. In finance, a derivative is an agreement based on an underlying asset. Instead of exchanging the actual asset, agreements are made to exchange cash or other assets for the underlying asset within a specified time frame. As the value of the underlying asset changes, so does the value of the derivative. Following the definition, we find that our lives are filled with derivatives. Credit cards, service agreements, and many other everyday contracts promise a service now in exchange for cash within the billing period, that is the specified period. Rather than being the boogeyman of financial destruction, derivatives are financial tools that, if used properly, make our lives easier. History shows that these financial instruments were developed to solve real world issues that needed to be solved for business. In other words, a derivative is a contract that derives its value from the performance of an underlying entity. This underlying entity can be an asset, an index, or interest rate, and is often called the underlying asset. Derivatives can be used for a number of purposes, including insuring against price movements, hedging, increasing exposure to price movements for speculation, or getting access to otherwise hard to trade assets or markets. Some of the more common derivatives include forwards, futures, options, swaps, and variations of these such as collateralized debt obligations, credit default swaps, and mortgage-backed securities. Derivatives are one of the three main categories of financial instruments, the other two being equities, that is stocks or shares, and debt, that is bonds and mortgages. The value of a financial derivative derives from a price of an underlying item such as an asset or an index. Unlike debt instruments, no principal amount is advanced to be repaid and no investment income accrues. Financial derivatives are used for a number of purposes, including risk management, hedging, arbitrage between the markets, and speculation. Financial derivatives enable parties to trade specific financial risks such as interest rate risk, currency, equity and commodity price risk, and credit risk, etc., to other entities who are more willing or better suited to take or manage these risks, typically, but not always, without trading in a primary asset or commodity. The risk embodied in a derivative contract can be traded either by trading the contract itself, such as with the options, or by creating a new contract which embodies risk characteristics that match in a countervailing manner those of the existing contract owned. Financial derivative contracts are usually settled by net payments of cash. However, some financial derivative contracts, particularly involving foreign currency, are associated with transactions in the underlying item. In finance, a forward contract, or simply a forward, is a non-standardized contract between two parties to buy or sell an asset at a specified future time at a price agreed upon today, making it a type of derivative instrument. This is in contrast to a spot contract, which is an agreement to buy or sell an asset on its spot date, which may vary depending upon the instrument. For example, most of the foreign exchange contracts have spot date 2 business days from today. The party agreeing to buy the underlying asset in the future assumes a long position, and the party agreeing to sell the asset in the future assumes a short position. The price agreed upon is called the delivery price, which is equal to the forward price at the time of contract is entered into. Price of the underlying instrument in whatever form is paid before control of the instrument changes. This is one of the many forms of buy-sell orders where the time and date of trade is not the same as the value date where the securities themselves are exchanged. Forwards, like other derivative securities, can be used to hedge risk, typically currency or exchange rate risk, as a means of speculation, or to allow a party to take advantage of quality of the underlying instrument, which is time sensitive. A closely related contract is a futures contract. They differ in certain respects. Forward contracts are very similar to future contracts, except they are not exchange traded or defined on standardized assets. Forwards also typically have no interim partial settlements or true-ups in margin requirements like futures, such that the parties do not exchange additional property, securing the party at gain, and the entire unrealized gain or loss builds up while the contract is open. In finance, a futures contract, more colloquially futures, is a standardized contract between two parties to buy and sell or sell a specified asset of standardized quantity and quality for a price agreed upon today, the futures price, with delivery and payment occurring at a specified future date, that is the delivery date, making it a type of derivative instrument. The contracts are negotiated at futures exchange, which acts as an intermediary between the two parties. The party agreeing to buy underlying asset in the future, the buyer of the contract is said to be long, and the party agreeing to sell the asset in the future, that is the seller of the contract, is said to be short. While futures contract specifies a trade taking place in the future, the purpose of the futures exchange institution is to act as an intermediary and minimize the risk of default by either party. Thus, the exchange requires both parties to put up an initial amount of cash for, that is performance bond, the margin. Additionally, since the futures price will generally change daily, the difference in the prior agreed upon price and the daily futures price is settled daily also, that is variation margin. The exchange will draw money out of one party's margin account and put it into another, so that each party has the appropriately daily loss or profit. If the margin account goes below a certain value, then a margin call is made and the account owner must replenish the margin account. The process is known as marking to market. Thus, on the delivery date, the amount exchanged is not the specified price on the contract, but the spot value, that is the original value agreed upon, since any gain or loss has already been previously settled by marking to market. Upon marketing, the strike price is often reached and creates lots of income for the caller. In finance, an option is a contract which gives the buyer, the owner, the right, but not the obligation to buy or sell an underlying asset or instrument at a specified strike price on or before a specified date. The seller has the corresponding obligation to fulfill the transaction. that is to sell or buy, if the buyer exercises the option. The buyer pays a premium to the seller for this right. An option which conveys to the owner the right to buy something at a specific price is referred to as a call. An option which conveys the right of the owner to sell something at a specific price is referred to as a put. Both are commonly traded, but for clarity, the call option is more frequently discussed. In basic terms, the value of an option is commonly decomposed into two parts. The first part is intrinsic value, which is defined as the difference between the market value and the underlying and the strike price of the given option. The second part is a time value, which depends on a set of other factors which, through a multi-variable nonlinear interrelationship, reflect the discounted expected value of that difference at expiration. Although options valuations has been studied at least since the 19th century, the contemporary approach is based on the Black-Scholes model. Black-Scholes model, which was first published in 1973. Options are a part of a larger class of financial instruments known as derivative products or simply derivatives. A swap is a derivative in which two counterparties exchange cash flows of one party's financial instruments for those of the other party's financial instruments. The benefits in question depend on the type of financial instruments involved. For example, in the case of a swap involving two bonds, the benefits in question can be the periodic interest, that is coupon payments, associated with such bonds. Specifically, two counterparties agree to exchange one stream of cash flows against another stream. These streams are called the legs of the swap. The swap agreement defines the dates when the cash flows are to be paid and the way they are accrued and calculated. Usually at the time when the contract is initiated, at least one of these series of cash flows is determined by an uncertain variable such as a floating interest rate, foreign exchange rate, equity price, or commodity price. The cash flows are calculated over a notional principal amount. Contrary to a future, a forward, or an option, the notional amount is usually not exchanged between the counterparties. Consequently, swaps can be in cash or collateral. Swaps can be used to hedge certain risks such as interest rate risk or to speculate on changes in the expected direction of underlying prices. Swaps were first introduced to the public in 1981 when IBM and the World Bank entered into a swap agreement. Today, swaps are among the most heavily traded financial contracts in the world. Collateral debt obligation Collateralized debt obligation, CDO. A collateralized debt obligation, CDO, is a type of structured or asset-backed security, that is ABS. Originally developed for the corporate debt markets, over the time, CDOs evolved to encompass the mortgage and mortgage-backed security (MBS) markets. Like other private label securities backed by assets, a CDO can be thought of as a promise to pay investors in a prescribed sequence based on the cash flow from the CDO collects from the pool of bonds or other assets it owns. The CDO is sliced into tranches which catch the cash flow of interest and the principal payments in sequence based on seniority. If some loans default and the cash collected by the CDOs is insufficient to pay all of its investors, those in the lowest, most junior tranches suffer losses first. The last to lose payments from defaults are safest, most senior tranches. Consequently, coupon payments and interest rates vary by tranche, with the safest, most senior tranches paying the lowest and the lowest tranches paying the highest rates to compensate for higher default risk. A credit default swap (CDS) is a financial swap agreement that the seller of the CDS will compensate the buyer, that is the creditor of the reference loan, in the event of loan default by the debtor or other credit event. The buyer of the CDS makes series of payments, that is called CDS fee or spread, to the seller and in exchange receives a payoff if the loan defaults. It was invented by Blight Masters from JP Morgan in 1994. In the event of default, the buyer of the CDS receives compensation, usually the face value of the loan, and the seller of the CDS takes possession of the defaulted loan. However, anyone can purchase a CDS, even buyers who do not hold the loan instrument and who have no direct insurable interest in the loan. These are called naked CDSs. If there are more CDS contracts outstanding than bonds in existence, a protocol exists to hold a credit event auction. The payment received is usually substantially less than the face value of the loan. Credit default swaps have existed since the early 90s and increased in use after 2003. CDSs are not traded on an exchange and there is no required reporting of transactions to a government agency. Some claim that derivatives such as CDS are potentially dangerous in that they combine priority in bankruptcy with a lack of transparency. A CDS can be unsecured, that is without collateral, and be at a higher risk for a default. A mortgage-backed security, MBS, is a type of asset-backed security that is secured by a mortgage or more commonly a collection, that is pool of sometimes hundreds of mortgages. The mortgages are sold to a group of individuals, that is a government agency or an investment bank, that securitizes or packages the loans together into a security that can be sold to investors. The mortgages of an MBS may be residential or commercial, depending on whether it is an agency MBS or a non-agency MBS. Multi-level marketing, MLM, is a marketing strategy in which the sales force is compensated not only for sales they generate, but also for the sales of other salespeople that they recruit. This recruited sales force is referred to as the participant's downline and can provide multiple levels of compensation. Other terms used for MLM include pyramid selling, network marketing, and referral marketing. Most commonly, the sales people are expected to sell products directly to consumers by means of relationship referrals and word-of-mouth marketing. Question number 112. When there is a difference between all receipts and expenditures of the Government of India, both capital and revenue, it is called a revenue deficit. Budgetary deficit, zero budgeting, trade gap, balance of payment problem. These are the options. The answer is the budgetary deficit. Anyway, let's understand the terms used in this question. Revenue deficit. When the net amount received, that is revenues less expenditures, falls short of the projected net amounts to be received. This occurs when the actual amount of revenue received or the actual amount of expenditures do not correspond with the predicted revenue and expenditure figures. This is the opposite of revenue surplus, which occurs when the actual amount exceeds the projected amount. A mismatch in the expected revenue and expenditure can result in revenue deficit. Revenue deficit arises when the government's actual net receipts is lower than the projected receipts. On the contrary, if the actual receipts are higher than the expected one, it is termed as revenue surplus. A revenue deficit does not mean actual loss of revenue. Let us take a hypothetical example. If a country expects a revenue receipt of rupees 100 and expenditure worth rupees 75, it can result in a net revenue of rupees 25. But the actual revenue of rupees 90 is realized and an expenditure is rupees 70. This translates into net revenue of rupees 20, which is rupees 5 lesser than the budgeted net revenue and is called as revenue deficit. Fiscal deficit. The difference between total revenue and total expenditure of the government is termed as fiscal deficit. It is an indication of the total borrowings needed by the government. While calculating the total revenue, borrowings are not included. Generally, fiscal deficit takes place due to either revenue deficit or a major hike in capital expenditure. Capital expenditure is incurred to create long-term assets such as factories, buildings, and other development. A deficit is usually financed through borrowing from either the central bank of the country or raising money from capital markets by issuing different instruments like treasury bills and bonds. Budget deficit. A status of financial health in which expenditures exceed revenue. The term budget deficit is most commonly used to refer to government spending rather than business or individual spending. The opposite of a budget deficit is a budget surplus, and when inflows equal outflows, the budget is said to be balanced. Budget deficit as a percentage of GDP may decrease in times of economic prosperity as increased tax revenue, lower unemployment, and economic growth reduce the need for government programs such as unemployment insurance. If the investors expect higher inflation rates, which would reduce the real value of debt, they are likely to require higher interest rates on future loans to government. Countries can counter budget deficits by promoting economic growth, reducing government spending, and increasing taxes. By reducing onerous regulations and simplifying tax regimes, a country can improve business confidence, thereby prompting improved economic conditions while increasing treasury inflows from taxes. Reducing government expenditures, including on social programs and defense, and reforming entitlement programs such as state pensions can result in less borrowing. A government budget is a government document presenting the government's proposed revenues and spending for a financial year. The government budget balance, also alternately referred to as general government balance, public budget balance, or public fiscal balance, is the overall difference between government revenues and spending. A positive balance is called a government budget surplus, and a negative balance is a government budget deficit. A budget is prepared for each level of government from national to local and takes into account public social security obligations. Zero-based budgeting is an approach to planning and decision-making that reverses the working process of the traditional budgeting. In traditional incremental budgeting, historic budgeting, that is called historic budgeting, departmental managers justify only variances versus past years, based on the assumption that the baseline is automatically approved. By contrast, in zero-based budgeting, every line item of the budget must be approved rather than only changes. Zero-based budgeting requires the budget request be re-evaluated thoroughly, starting from the zero base. This process is independent of whether the total budget or specific line items are increasing or decreasing. Trade gap means the amount by which the value of a country's visible imports exceed that of visible exports, that is, an unfavorable balance of trade. The commercial balance or net exports is the difference between the monetary value of the exports and imports of output in an economy over a certain period measured in the currency of that economy. It is a relationship between a nation's imports and exports. A positive balance is known as a trade surplus if it consists of exporting more than it is importing. A negative balance is referred to as a trade deficit or informally a trade gap. The balance of trade is sometimes divided into a goods and services balance. BOP, that is balance of payments of a country, is the record of all economic transactions between the residents of a country and the rest of the world in a particular period, that is over a quarter of a year or more commonly over a year. These transactions are made by individuals, firms and government bodies. Thus, the balance of payments include all external visible and non-visible transactions of a country during a given period, usually a year. It represents a summation of country's current demand and supply of the claims on foreign currencies and of foreign claims on its currency. In other words, balance of payments accounts are on accounting record of all monetary transactions between a country and the rest of the world. These transactions include payments for the country's exports and imports of goods, services, financial capital, and financial transfers. The BOP accounts summarize international transactions for a specific period, usually a year, and are prepared in a single currency, typically the domestic currency for the country concerned. Sources of funds for a nation, such as exports or the receipts of loans and investments, are recorded as positive or surplus items. Uses of funds such as for imports or to invest in foreign countries are recorded as negative or deficit items. When all components of the BOP accounts are included, they must sum to zero with no overall surplus or deficit. For example, if a country is importing more than it exports, its trade balance will be deficit. But the shortfall will have to be counterbalanced in other ways, such as by funds earned from its foreign investments, by running down central bank reserves, or by receiving loans from other countries. The term balance of payments often refers to this sum. A country's balance of payments is said to be in surplus. Equivalently, the balance of payments is positive by a specific amount if the sources of funds, such as exports or goods sold and bonds sold, exceed uses of funds, such as paying for imported goods and paying for foreign bonds purchased by that amount. There is said to be a balance of payments deficit. The balance of payments is said to be negative if the former are less than the latter. A BOP surplus or deficit is accompanied by an accumulation or decumulation of foreign exchange reserves by the central bank. Under a fixed exchange rate system, the central bank accommodates those flows by buying up any net inflow of funds into the country or by providing foreign currency funds to the foreign exchange markets to match any international outflow of funds, thus preventing the fund flows from affecting the exchange rate between the country's currency and other currencies. Then, the net change per year in the central bank's foreign exchange reserves is sometimes called the balance of payment surplus or deficits. Alternatives to a fixed exchange rate system include a managed float where some changes of exchange rates are allowed, or at the other extreme, a purely floating exchange rate, also known as purely flexible exchange rate. With a pure float, the central bank does not intervene at all to protect or devalue its currency, allowing the rate to be set by the market, and central bank's foreign exchange reserves do not change, and the balance of payments is always zero. Question number 113. Which of the following is not a function of the Reserve Bank of India? The options are fiscal policy functions, exchange control functions, issuance, exchange and destruction of currency notes, monetary authority functions, supervisory and control functions. The preamble of the Reserve Bank of India describes the basic functions of the Reserve Bank as to regulate the issue of banknotes and keeping the reserves with a view to securing monetary stability in India and generally to operate the currency and credit system of the country to its advantage. The main functions are monetary authority. Under this, it formulates, implements and monitors the monetary policy, the objective being maintaining price stability and ensuring adequate flow of credit to productive sectors. Then regulatory and supervisor of the financial system prescribes broad parameters of banking operations within which the country's banking and financial system functions. The objective being maintain public confidence in the system, protect depositors' interest and provide cost-effective banking services to the public. Then, as a manager of foreign exchange, it manages the foreign exchange management under Foreign Exchange Management Act 1999. Objective being to facilitate external trade and payments and promote orderly development and maintenance of foreign exchange market in India. Then as an issuer of currency, it issues and exchanges or destroys currency and coins not fit for circulation. The objective being to give the public adequate quantity of supplies of currency, notes and coins in good quantity. Developmental role performs a wide range of promotional functions to support national objectives. And related functions, as a banker to the government, performs merchant banking function for the central and state governments, also acts as the banker. And as a banker to banker, bank maintains banking accounts of all scheduled banks. Question number 114. Which of the following is not required for opening a bank account? The options are identity proof, address proof, recent photographs, domicile certificate, none of these. The answer is domicile certificate. In any case, let us go into the details of this question. The list of acceptable documents for proof of identity are as under: a photo, a PAN card, voter's identity card, permanent laminated employee ID card issued by government, public sector undertaking, private limited, list of acceptable documents for proof of identity are as under: a photo, a PAN card, voter's identity card, permanent laminated employee ID card issued by government or public sector undertaking. Private limited company ID cards will not be accepted. Certificate of practice issued professional bodies like ICAI, ICSI, ICWAI, ICFA can be accepted. Bank passbook with attested customer photograph and signature only from scheduled commercial banks. Defense ID. A passport valid as on date. Permanent driving license which is valid with the photograph affixed thereon. Job card issued by NREGA duly signed by an officer of the state government. Letter or card issued by Unique Identification Authority of India containing details of name, photograph, address and Aadhaar number. Accordingly, either physical Aadhaar card or letter issued by UIDAI, that is Unique Identification Authority of India, received through post or the Aadhaar number validated through the e-KYC process adopted by the bank is acceptable as an officially valid KYC document for onboarding the customer and for re-KYC purpose. Further, the photo ID card issued by any of the following organizations or institutions are acceptable. That is central government or any of its ministries, statutory or regulatory authorities, state government or any of its ministries, public sector undertaking established under Government of India or a state government of Jammu and Kashmir, Bar Council, Senior Citizen Card issued by State or Central Government, Government of India to persons of Indian origin, that is PIO card, Defense Department, Ministry of Defense for defense personnel and their dependents, public financial institutions and public sector banks. Now for proof of address, the following documents are acceptable. Water bill. At least 2 bills are required. One bill should be of the last year and the other bill of current year. Telephone, landline or post-paid mobile bill. At least 2 bills are required. One bill should be of last year and other bill of current year. Electricity bill. At least 2 bills are required. One bill should be of the last year and the other bill of current year. 1 year statement with transactions or passbook of running bank account of public sector banks only. Income tax assessment order. Election Commission photo ID card. Proof of gas connection. Certificate from employer of reputed companies on letterhead only. Only public limited companies can give address proof on company letterhead along with sheet. Computerized printouts shall not be entertained. Spouse's passport copy. First and last page including family details, provided the applicant's present address matches the address mentioned in the spouse's passport. The applicant's current and valid ration card. If any applicant submits only a ration card as a proof of address, it should be accompanied by one more proof of address out of the given categories. Parents' passport copy in case of minors. Aadhaar card. If your Aadhaar card issuance date is less than a year from passport application processing date, it should be accompanied by one more proof of address out of the given categories. Registered rent agreement for a period of more than 1 year. Please note, for minor applicants, present address proof document in the name of parents can be submitted. A domicile residence certificate is generally issued to prove that the person bearing the certificate is a domicile or resident of the state or union territory by which the certificate is being issued. This certificate is required as proof of residence to avail domicile for resident quotas in educational institutions and in the government service, as also in the case of jobs where local residents are preferred. You will be required to produce proof of continuous residence in state or union territory for a specified minimum period, or that of holding land in the state or union territory, depending on the rules in the state or union territory concerned. The documents for proving your identity, attestation of the form by officers with necessary authorities, school certificates and Tehsil inquiry report may also be required. Women not originally belonging to a state or a union territory, but married to men who are permanent residents of the state or union territory, or who are eligible for the state's or union territory's domicile certificate, are eligible to apply for a domicile certificate. Question number 115. The Golden Jubilee of Afro-Asian Development Organization was organized in which of the following places in March 2012? The options are Dhaka, Tokyo, Cairo, Kuala Lumpur, New Delhi. Let us consider the details of all these items in this question. Afro-Asian Rural Development Organization, AARDO, formed in 1962, is an autonomous intergovernmental organization comprising 15 African members and 14 Asian members. AARDO is devoted to develop understanding among members for better appreciation of each other's problems and to explore collectively opportunities for coordination of efforts for promoting welfare and eradication of thirst, hunger, illiteracy, disease and poverty amongst hundreds of millions of rural people. Dhaka is the capital of Bangladesh. Dhaka is the most populous city in Bangladesh and the 10th largest city in the world with a metropolitan area of 12 million inhabitants. It is standing on the east bank of Buriganga River. Dhaka is the political, economic and cultural heart of Bangladesh. It is one of the major cities of South Asia. Historically known as the city of mosques, it is also nicknamed as the rickshaw capital of the world with its daily traffic of over 500,000 cycle rickshaws. Tokyo, officially known as Tokyo Metropolis, is one of the 47 prefectures of Japan. Tokyo is the capital of Japan, the center of the Greater Tokyo area and the most populous metropolitan area in the world. It is the seat of the Japanese government and the imperial palace and the home of the Japanese imperial family. Tokyo is in the Kanto region on the southeastern side of the main island, Honshu. Tokyo is often referred to and thought of as a city, but is officially known and governed as a metropolitan prefecture, which differs from and combines elements of both a city and a prefecture, a characteristic unique to Tokyo. The prefecture is a part of the world's most populous metropolitan area with upwards of 37.8 million people and the world's largest urban agglomeration economy. The city hosts 51 of the Fortune Global 500 companies, the highest number of any city. Cairo is the capital of Egypt and the largest city in the Middle East and second largest in Africa after Lagos. Its metropolitan area is the 16th largest in the world. Located near the Nile Delta, it was founded in AD 969. Nicknamed the City of 1,000 Minarets for its preponderance of Islamic architecture, Cairo has long been a center of the region's political and cultural life. Cairo is also associated with ancient Egypt as it is close to ancient cities of Memphis, Giza and Fustat, which are near the Great Sphinx and the Pyramids of Giza. Egyptians today often refer to Cairo as Masr, the Egyptian Arabic pronunciation of the name for Egypt itself, emphasizing the city's continued role in Egyptian influence. Cairo has the oldest and largest film and music industries in the Arab world, as well as the world's Second oldest institution of higher learning, Al-Azhar University. Many international media, businesses and organizations have regional headquarters in this city. The Arab League has had its headquarters in Cairo for most of its existence. With a population of 6.76 million spread over 453 square kilometers, Cairo is by far the largest city in Egypt. With an additional 10 million inhabitants just outside the city, Cairo resides at the center of the largest metropolitan area in Africa and the Arab world, as well as the 10th largest urban area in the world. Kuala Lumpur. Kuala Lumpur is the federal capital and most populous city of Malaysia. The city covers an area of 243 square kilometers and has an estimated population of 1.6 million. Greater Kuala Lumpur, also known as the Klang Valley, is an urban agglomeration of 6.9 million. It's among the fastest growing metropolitan regions in the country in terms of population and economy. Kuala Lumpur is the seat of the Parliament of Malaysia. Rated as an Alpha World City, Kuala Lumpur is the cultural, financial and economic center of Malaysia due to its position as the capital as well as being a key city. Kuala Lumpur was ranked 48th among the global cities. Since the 1990s, the city has played host to many international sporting, political and cultural events. In addition, Kuala Lumpur is home to the tallest twin buildings in the world, the Petronas Twin Towers, which have become an iconic symbol of Malaysia's futuristic development. New Delhi. New Delhi is the capital of India and seat of executive, legislative and judiciary branches of the Government of India. It is also the center of the Government of National Capital Territory of Delhi. New Delhi is situated within the metropolis of Delhi and is one of the 11 districts of Delhi National Capital Territory. With a population of 22 million, the Delhi metropolitan region is the world's fifth most populous, the largest in India and also one of the largest in the world in terms of area. After Mumbai, it is also the wealthiest city in India and has the second highest GDP of any city in Southwest or Central Asia. The foundation stone of the city was laid by George V, Emperor of India, during the Delhi Darbar of 1911. It was designed by British architects Sir Edwin Lutyens and Sir Herbert Baker. The new capital was inaugurated on 13th February 1931 by India's Viceroy Lord Irwin. Question number 116. What is the maximum deposit amount that is issued by DICGC? Options are rupees 2 lakhs per depositor per bank, rupees 2 lakhs per across all banks, rupees 1 lakh per depositor per bank, rupees 2 lakhs per across all banks, none of these. Deposit Insurance and Credit Guarantee Corporation, that is DICGC, is a subsidiary of Reserve Bank of India. It was established on 15th July 1978 under DICGC Act 1961 for the purpose of providing insurance of deposits and guaranteeing credit facilities. DICGC insures all bank deposits such as savings, fixed, current, recurring deposits for up to the limit of rupees 1 lakh of each deposit in a bank. Question number 117. The present foreign trade policy of India will continue till December 2012, March 2013, March 2014, June 2013, December 2014. The foreign trade policy provides the overarching framework for catalyzing India's exports. The foreign trade policy for the period 2009 to 14 was announced on 27th August 2009 in a difficult economic backdrop as the world was emerging from the shadows of a grim recessionary period. A multi-pronged strategy was adopted to arrest the fall and reverse the trend of declining exports. In the last 3 years, we have maintained a stable policy environment and have consciously adopted a market diversification plan reaching out to non-traditional destinations, focusing on emerging markets in Africa, Latin America, and Asia. We have remained conscious of the fact that exports is not just an end in itself, but means of providing gainful employment to millions of the people in the country. Therefore, employment-intensive sectors have received our special attention. We have been administering the fiscal incentives under the different schemes like Focus Market Scheme, Focus Product Scheme, Market Linked Focus Product Scheme to provide support to identified priority sectors. Question number 117. The present foreign trade policy of India will continue till December 2012, March 2013, March 2014, June 2013, December 2014. The foreign trade policy provides the overarching framework for catalyzing India's exports. The foreign trade policy for the period 2009 to 14 was announced on 27th August 2009 in a difficult economic backdrop as the world was emerging from the shadows of a grim recessionary period. A multi-pronged strategy was adopted to arrest the fall and reverse the trend of declining exports. In the last 3 years, we have maintained a stable policy environment and have consciously adopted a market diversification plan reaching out to non-traditional destinations, focusing on emerging markets in Africa, Latin America, and Asia. We have remained conscious of the fact that exports is not just an end in itself, but means of providing gainful employment to millions of the people in the country. Therefore, employment-intensive sectors have received our special attention. We have been administering the fiscal incentives under the different schemes like Focus Market Scheme, Focus Product Scheme, Market Linked Focus Product Scheme to provide support to identified priority sectors.